What I'm gonna show you is a restaurant that's on a ground lease and how I would analyze this as an investment if I were looking at purchasing. Ground leases are absolutely passive in the most part, and that's exactly true for this one. But even though something is really low energy, extremely passive, and the money can be good, we still have to make sure we're getting a good investment. So with that being said, let's start analyzing. All right, so here we are on the computer, and I've got a property that's currently for sale in Clarksville, Tennessee. This is on LoopNet. Anybody can go look at this. This property is not under contract, and they've got some interesting information here. This is 950 square feet. It's a coffee shop. They're asking $1,978,000, which is $2,082 a square feet, and it is 4.5% cap rate, okay? Now, we can kind of scroll through here. We analyzing the property, which is cool. All the other, stores around this, 1 mile, 3 mile, 5 mile radiuses. We got 72,000 people, strong household incomes. What they haven't told us here is whether this is an average or a median income, which we'd want to get clear on because those two can vary a lot in what they mean. And then we just got a map of it. Cool. So nothing major there. Let's read through. New single tenant Dutch Bros Coffee with a drive-through. Brand new 2020 construction. Store is scheduled to open in August of 2022. So it should be open now. We're in October. Significant economic growth and development in Clarksville. That's a soft statement, but that's okay. New 15-year absolute net corporate ground lease. 10% increase every 5 years. This is major for our analysis, okay? Dense retail corridor, Walmart, Food Line, Planet Fitness, Cold Stone, AT&T, Waffle House, Shell, Smoothie King, Jersey Mike's, Taco Bell, Wendy's. Sound like it's on the main drag strip is what they're trying to say, and this is Nashville, MSA. So the price is $1,978,000. That is the cap rate of 4.5%. So let's do a little bit of math here. I'm just going to do some really simple math. If we did $1,978,000, 1, 2, 3 times 0.045%, that gives us $89,010, okay? Now notice the NOI is also $89,000. Why is that? That's because this is an absolute triple net, which means we incur zero expenses. We don't do maintenance, we don't pay insurance, we don't do property taxes, we do nothing. They send us money, we literally keep 100% of it. There are no expenses we have to pay, which is really, really cool. The other thing about this, guys, is that this is a ground lease. Okay, what the ground lease means is you don't own the building. Okay, you own the dirt, and that's what you're leasing out, and they have a building on top of it. Now, obviously, if somebody puts a building on top of it, there's most likely always going to be somebody who wants to occupy that building, and if somebody wants to occupy that building, therefore, they have to lease the ground from you, right? There is no circumstance in which they can have a building on your ground and not be paying you, okay? So let's go through this. There's a 15-year corporate-backed ground lease. The reason that corporate-backed is important is it's not just like, hey, if your buddy Joe is wanting to become an entrepreneur and he's wanting to start a coffee shop and he starts his first location, Joe is the person backing that lease with the landlord. Versus corporate is like Starbucks. I've never been to a Dutch Bros or heard of them, so I don't know that the corporate nature of that is that, fulfilling to me. But if somebody told you, hey, the corporation of Starbucks is backing this lease, you'd feel a lot better about that as a real estate investor and as a landlord than you would if it's like, oh, Joe is backing this lease, right? Who's Joe? What's his financial situation? We want Starbucks to back us. We want a corporation to back us. So that's cool. So what I want to do, guys, is really we have all the information we need to go through and kind of analyze this deal. I mean, again, I would dive down more into the, into the demographics of the area, but let's just say that it's strong, as they say. So I'm going to come to my property stats, which is what I use to analyze deals. I'm going to click analyze, and I'm going to hit analyze from scratch. Now we're going to open up a new deal, and let's just nickname this the Dutch Bros in, or is this Clarksville? And I could fill out all this information, but for the purpose of this video, I'm not. We're gonna call this a retail. It's 1 unit. It is, 950 square feet? Is that right? 950, and they're asking $1,978,000. So I'm gonna come back and I'm gonna drop that in my purchase price, and I'm gonna say this is a cap rate. Now, guys, They are saying that this is a 4.5% cap rate. I don't know the ground lease corporate-backed market in Clarksville, Tennessee. I would have to do some research on that. But what I'm going to tell you is that if inflation is 8%, if interest rates are, I think prime right now is at 5.5%, there's really no investment in the world that makes a lot of sense to be a 4.5% cap rate. If we could go and lend money at 5.5% and have personal guarantees, we wouldn't take the risk of owning real estate. The reason that real estate is going to earn more money than just straight up lending money at the prevailing interest rates in the market is because there's risk associated with that. There's risk that the tenant doesn't pay, you have to evict them, whatever it is, there's risks in real estate, okay? So why in the world, if we were going to take on the risk of being a real estate investor, even in a ground lease like this, why in the world would we be willing to earn less than we could just lend money at? We wouldn't be, right? So 4.5% cap rate is what they're trying to sell it to you at. That does not mean what it is worth, okay? So I don't know the market that well, but I'm going to say it's probably around a 7 cap, right? If I could go out and earn 7% absolutely passive, I would die for that. That would be awesome. And a lot of other investors would too. But they're trying to sell to you at a 4.5. That doesn't mean that's what the actual value is. As you've noticed, this is an on-market deal. I talk about on-market deals not being the best deals, and nobody has bought it yet, which means that it's probably priced too high, right? 4.5% cap rate isn't right. So I'm going to leave their purchase price in here just to show this to you guys, but the cap rate on the resale is I'm going to analyze at a 7%, okay? Now let's say that I'm going to go get a loan. Let's say I'm going to go get a loan at 75% LTV. Let's say it's going to be a 6.5% interest rate, and let's say it's going to be a 25-year loan or 300 months, okay? So my payment on that is going to be $10,016 a month. I'll have prepayment penalties. I'm going to have some closing costs. We'll maybe call it $20,000 of closing cost on this deal. No improvements, right? Ground lease. I also don't need any working capital because I don't have any bills to pay. So no working capital is needed. So if we look at this deal, I'm going to buy it for $1,978 at the asking price. The closing cost can be $20,000. So total cost of this deal is creeping up right under $2 million. And I need to bring $514,000 to the table. That's step one of analyzing this deal done. We only have 3 steps. So number 2 is let's go to the income, okay? So let's go back and read real quick. Again, we have $89,000 of NOI here. That's our income, $89,000. So how are we going to do that? Well, we got a couple different ways inside my property stats for Airbnbs and whatnot. We can, and hotels, we can do daily rates, RV parks. For normal self-storage, rental houses, apartments, whatever it is, we can have monthly rates. And then annual per square foot is more for the retail or for something like that. So you can really do it however you want. If you want to come in here and you want to put in, it's 1 unit and there's 950 square feet, and we'll just call this the Dutch Bros building. And then we could come in here and we could do an annual per square foot, 950 square feet. So all we'd have to do is figure out how much per square foot are we leasing for a year, right? So what we're going to do is we're going to come in here and we're going to take the 89,000, and we're going to divide that number by the 950. So that means that we're getting $93.68 per square foot, which is really high. $93.68. Okay, so as we can see here, that takes me, we're just under that. So did I do my math right? 69 cents. There we go. Rounding error. So $89,006 a year. We'll round up, we'll round down, whatever it is. Now we have to worry about our future rental rates, right? Because they say here that there's a 10% increase every 5 years, which means that year 1, 2, 3, 4, and 5, it's just $89,000. Then in year 6, every 5 years, right? Year 1 plus 5 is year 6. It's going to go up by 10%. So in my property stats, all we do here is we have a 0% increase. 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 And we can see that that's going to keep our PGI the same. And then in year 6, we have a 10% increase, right? So I'm just going to enter a 10% increase. So that shows that in year 6, we're going to get $97,000. And again, now we're going to have a 0% increase. Now we're going to have a 0% increase. Okay, 0, 0, 0, because that's years 1, 2, 3, 4, 5. And then here in year 11, we're going to have a 10% increase again. Okay, and then we're going to go up to $107,000. And then again, it's only a 15-year lease. So what we're going to do is we're just going to show zeros all the way through then, and then we're going to renegotiate the lease, and we'll just assume we go up at 2% a year. So we have all of our income dialed in. That's how you would enter in the My Property Stats system, just a preset a lease where it doesn't raise every year, but it raises every 5 years. Okay, so let's roll over to expenses. Oh, guess what? We don't have any expenses. So we literally don't have to enter anything in here. So step 1 was entering all the purchase info. Step 2 was entering the income. And step 3 was the expenses. We're good. Let's go check out how good of an investment this deal is going to be. So we click on our pro forma, and we got some flashing red signals here, guys. So even though we don't have to do anything on this, if we were to go out and if we were to get a loan on this and buy it like a normal investment, we would lose $35,000 a year. We would have to pay almost $3,000 a month just to own this property. That's the difference between the income that's coming in, and that's the difference between the mortgage payment that we would have to pay, because that's our only expense is the mortgage payment. And that's not really an operating expense. It's a debt service line item. But you can see that that's how this rolls out, right? You can see, one quick thing that I forgot to change, vacancy and concessions. Okay, so what we can enter here is that our occupancy is 100%. The system defaults to 95%, which is fine there. We can come back to the pro forma and we can get rid of that. So really we lose about $30,000 right there, okay? Losing $30,000. Now let's take a look at the property value. The property value is only $1.2 million. Remember, we paid almost $2 million in total for this thing. So if we were to sell this property, we would be losing money. We'd not only lose the money we put into the deal, the $500,000, but we'd have to pay another $336,000 to get out of this deal. So we'd lose a total of $800,000. Now, it's not till year 11 that you would even really get your money back on this, and that's just because of how it works, and that's also by chance when you would start to actually cash flow something. So overall, the signs on this is it's a really poor deal at that price. That doesn't mean that it's a poor deal at any price though. So let's go check out our goal seek, and let's say if we wanted to earn a 10% on the money we're going to put in, right, in year 1 and beyond, how much could we pay for this building that they're asking almost $2 million for? So I'm just going to say in year 1, I want to make 10%, and I'm going to hit seek answer. And here's what's going to happen is it's going to start to compute and tell me the exact price I could pay. So if I wanted to make 10% on my money, absolutely passively, the system just calculated this for me. I could pay $1,014,000. $1,014,421, excuse me. And that is how much I would probably be willing to pay for this deal. Somebody else may be willing to accept, a 6% return on their money, maybe a 7% return on their money, in which case they could pay more. But that's how, if I were analyzing a deal like this, it is absolutely net, very little risk. That's how I would go through and analyze, is this a good deal for me to put my money into? If you want a 14-day free trial to My Property Stats, you can absolutely have that. That's my software. It's not just for these kind of deals, it's for any kind of real estate deals. So if you want that, I'll put the coupon code in the description below so you can get a 14-day free trial on the system. Hope you guys enjoyed it. See you in the next video.